So let's talk about the daily chart for swing trading. It's one of the most popular time frames for swing traders. It's my favorite because it allows you to take advantage of the trend while spending limited time at your screen. So in this time frame, each candlestick represents 1 day of trading activity. Now, one important aspect of using the daily chart for swing trading is make sure you identify key price levels. And these are areas where price has previously shown support or resistance, and it might do so again in the future. And at these levels, traders will use them to enter or exit trades, set their stop losses, take profits. It can also be important for some to use an indicator for swing trading, such as moving averages, the RSI, to confirm any potential trade setups. Let's talk about the weekly chart. It's also useful. Now, this is going to allow you to see how prices have moved over multiple weeks and identify these levels of support and resistance that are important. A rule of thumb is that the longer these levels are in place, not always tested, but in place, the stronger it could be when price returns. The 4-hour one, this time frame can be useful, especially if you prefer to hold positions for a few days, up to a week, depending on the trend, of course. Some excellent swing trading indicators that work well with that 4-hour chart: moving averages, Bollinger Bands, stochastic oscillators. These are great tools that help traders analyze what they're seeing on the chart and make better decisions about their trades. Now, hourly chart swing traders, they usually have a bit of a higher risk tolerance than those who trade on longer time frames. They often take advantage of those short-term price fluctuations that we see by opening and closing their positions quite quickly. 30 minutes, another popular one, gives you a lot of detail on those charts. At this level, listen, we're getting into the area of day traders, but if you can latch onto strong trends, you could end up carrying the trade for a few days. So choosing the right chart, it's going to depend on the type of trader you are. That's the bottom line. So understand what information you're looking for. You want short-term trends, long-term trends? Do you need real-time data for what you need? For daily charts, you don't usually need it. Do you need the ability to design custom indicators, right? That's going to depend on your charting platform. Once you have an understanding of that, then you've got to think, am I going to use line charts, bar charts, candlestick charts, Heikin Ashi? But for the most part, bar charts, candlestick charts, they're the ones that people generally use. So let's talk about technical analysis tools. Every trader likes to use these, and I like them because they can help you objectively look at price. A lot of platforms are going to have tons for you to choose from. Here's a few. Moving average just calculates the average price of an instrument over a specified period. You can use that for anything: trends, entry and exit points, whatever. The MACD, one of my favorite ones, by using a modified version. Trend following momentum indicator. All it does is show the relationship between two moving averages. RSI, momentum oscillator, measures the strength and speed of an instrument's price movement. Some traders use it for oversold and overbought conditions. Bollinger Bands, a technical analysis tool again, uses a moving average with two trading bands above it and below it. Use it to measure volatility and also potential entry and exit points somewhere within those three lines. So Fibonacci, it gets a bad rap. Some people find these useful. Automatic potential support and resistance levels. These aren't bad. They just show up on your chart. Not every platform is going to have them. I use TradingView. Those have them, but I don't use them, but you certainly can. Let's talk about moving averages. Again, these are just indicators. It calculates an average price. There's different calculation methods, and they work best when used with other tools like price action. So generally, a swing trader is going to use a simple moving average and an exponential moving average, SMA and EMA. The SMA, very straightforward calculation. It's the average price over a set number of periods, all of them weighted equally. EMA is going to give more weight to the recent price action. That just makes it better suited for shorter term trading strategies, absolutely. Now, both of them have their advantages, their disadvantages. You just use whatever works for you. I don't really see much of a difference in the two unless we see a big volatility spike. Some common mistakes, there's a few, we all make them. One of the biggest one is not having access to a solid trading platform with good charting packages. Without some decent data and tools, it can be difficult to make decisions about trading. Another one, understanding basic market structure. It's really important that you know how the market works, what factors influence price movements in order to develop an effective strategy. Again, this is going to include support and resistance levels, trends, tactical indicators. 4 quick tips: always use reliable charting software. Understand the basics behind how price moves. Be patient. Don't rush into trades without a trading plan. Period. Bottom line. Put that on your forehead. Do not let emotions guide your trading decisions ever. Wrapping this is an indicator blueprint. Talking about moving averages, Keltner channels, stochastics. Again, I like Keltner channels over Bollinger Bands. Now, a lot of people charge a lot of money for courses like this, but you can grab it here. The link is over here to the left or down below into the description. Make sure you hit like and subscribe. We'll talk to you soon.